Thank you all for coming. My name is Lisa. I'm a librarian at Saratoga Library, and I'm very happy to bring this program to you. Our speaker today is Larissa Prytula, who is a certified financial planner, and she has done programs with the library district for many years now. She's educated over 2,500 people as the leader of the pro bono team with the Financial Planning Association of Silicon Valley. Please welcome Larissa.
Thank you so much, Lisa, for the great introduction. I appreciate it. I was just sharing with Lisa that my relationship with library started very long time ago. When I first brought my son more than 20 years ago to the library. It's an amazing facility and a great program that Lisa has been running for years. So thank you for that, Lisa. Today, we'll talk about tax optimization, best tax practices, strategies. Very timely topic because we're all, most of us probably, getting our act together to file taxes. I hope a lot of people already filed, but there's few people that are still in the process of filing. The deadline is the 16th, next Monday. A little bit about me, very briefly. As Lisa mentioned, I'm certified financial planner. I also hold certified divorce financial analyst designation, and I've been having my own practice for over 13 years so far, and previously I was in accounting role and working at the banking industry. So my passion for education came from actually a long time ago when I was helping students through financial literacy. And later on, through Financial Planning Association, which is a non-profit organization, that department that I was in charge of was helping library programs and across entire Silicon Valley. And Saratoga Library was our favorite. We had a wonderful time working with participants. I also had financial planning days at the library in the past. So our relationship comes very long, and we're very happy that we're here today. So let's talk about taxes and see if we can pack a lot of information in 1 hour. And I hope that you will walk away with some more information and knowledge about how to handle your own taxes, or even ask right questions of your tax professional. So you can see here that a tax planning advice is unfortunately not very widespread. Services received from tax advice is only 25%, where the desired is almost 90% of people are interested to get more tax services. So there is a lot of demand for it. So I hope to cover some of that demand today. And definitely we can look into, how we can, sorry, I skipped. How we can optimize our taxes on our own and also with the help of a professional. So we'll cover a few topics: ordinary income, what it is, how we will optimize, minimize it, investment income, itemized deductions, legislative updates that just came recently. It's actually beginning of the year. We passed Secure Act 2.0, and what steps you would like to take, or you would like your tax advisor to take. So first, let's focus on ordinary income. This is our tax brackets between most common filing statuses, married filing jointly. You can see the tax 10% would be up to 22,000. For single person, is pretty much half of it. So you can see that brackets are moving, and they're moving rapidly. So from 24%, it goes all the way to 32, 35, and 37. However, there is no higher tax bracket as 37%. That's a slight change that we have seen. So 37% is the highest tax bracket, but keep in mind, not all of your money are taxed at 37% because it's a gradation system. So this is the most up-to-date brackets. Now, let's talk about Affordable Care Act taxes and what it had imposed on us. So people who have a modified adjusted gross income above $250,000 or singles with 200, they will be subject to Medicare hospital tax. This is the rate, 0.9%. And what's subject to it is your wage, compensation, and self-employment income. Additional net investment income, that's taxed only at interest, dividends, capital gain level, LRECs. So if your income is exceeding $250,000 or more, MAGI, modified adjusted gross income, MAGI, by the way, does include half of the Social Security income, unfortunately, then you could be subject to 3.8% Medicare surtax on that difference. A lot of times, this tax is assessed at the time when people realize huge amount of capital gains. One example, you sold your primary residence or you sold your rental property, and out of sudden your income goes from 200,000 to 600,000. The difference between that 600 MHI and a $200,000 threshold would be subject to this Medicare surtax, we call it. This is not new, it's been around since Obamacare, but a lot of people miss that, so that's important to know. So exemption and brackets. So I don't know how many people on this podcast are subject to alternative minimum tax, but I would like to mention that there is some exemption amounts that applies to alternative minimum tax, and that exemption will phase out based on income. Obviously, you can see that income level is very high, but once you hit alternative minimum tax, remember that your tax rate is flat on the difference. The difference between the ordinary income tax you owe and alternative minimum tax that can be applied on the top of it. The good news is these phase out ranges are much larger than we've seen before. So at least I see less and less people are subject to alternative minimum tax, but few folks do pay. So you can see that the tax rate becomes flat after certain amounts. So now one important consideration. Let's talk about the tax considerations for alternative minimum tax. When you become a subject to AMT, we call it, right? Then the best thing to do is to accelerate your income if possible. If you need to sell more stocks, if you want to defer some deductions like a charitable contribution, since you already hit the AMT tax and now you're at the flat rate for that amount that's over, it's probably much better for you to stay at that rate. Why? Because remember, ordinary income tax goes up higher and higher and higher, up to 37%. So once you hit an AMT tax, accelerating income might not be a bad idea. If you are subject to regular taxes, then it's completely different strategy applies. Means defer capital gains, defer pension benefits, defer social security as much as you can and as much as you can afford, and accelerate your deductions. In a few slides, we'll talk about charitable deductions, property income tax deductions, and how to stack them all together. But most importantly is if you're an ordinary income tax rate, please make sure that you optimize every single deduction you can, because every dollar that gets you over your threshold, the bracket, will be taxed at a higher level. Moving on to how we manage taxable income. There are some years where we have higher taxes, capital gains. 2021, a lot of people made a lot of money in the market, capital gains were higher, versus 2022, completely different story. So if 2021 is your higher tax year, what would considerations you would have? So you can increase your retirement income contributions. You can accelerate your charitable giving. We'll talk about charitable giving in greater details under deductions. You can recognize capital losses, which is one of the best way for you to reduce your capital gains. Offsetting your capital losses, actively looking for capital losses, offsetting them against capital gain can wipe out a lot of your capital gain income tax that you would have to pay. So extremely important for you to look through your entire portfolio to see if you already realize capital gains, is there any opportunity for you to harvest losses so those losses can offset the gains and you'll pay by far less tax. Avoid capital gain recognition. One way to avoid capital gain recognition is to invest in individual stocks or exchange traded funds. Why? Because those instruments are not actively distributing capital gains, versus actively managed mutual funds. Usually by end of the good year will have a bunch of gains reported on your 1099, and even though you haven't used the money, guess what, you have to pay tax. So you need to be very careful about it. Defer retirement account distributions. Great news that Secure Act 2.0 postponed all required minimum distributions for a group of people that were born between 1951 and I believe 1959, that you do not have to take RMDs, required minimum distribution, at 70.5 anymore. You can take them at 73. So postponing and deferring your RMDs will also lower your overall tax bracket. So that's what you can do when your tax year is high. And then the lower tax years is completely opposite. You can defer any charitable giving. You can give in a higher tax year and give very little in a lower tax year. It will help you with the tax bracket a lot. Also, deferring delaying pass-through business expenses. For instance, if there is an expense that you can occur in a higher tax year, you can occur it on January 1st, January 2nd. Maybe you're buying an equipment. Instead of buying in a lower tax year, you can buy in the following year if you know your revenue will be higher going forward. You can also recognize certain capital gains. And that's a very interesting strategy where you can sell one security and buy a replacement security, and you're basically establishing a new cost basis. And if it's your lower tax year, you might not pay a lot of capital gain tax, if any at all. By the way, just speaking of capital gains, there might be a slide about it, but I'll let you know that certain amount of gains, if you have no other income, might not be even taxable. Considering ROS conversion, we in my practice use ROS conversion all the time. Every single year we reevaluate if ROS conversion is applicable and beneficial, because if somebody retires at age of 60 and not collecting Social Security and not taking income from IRA, at that point the person might have very, very low total income, and in order to utilize standard deduction, which is now very high, you can do certain IRA to ROS conversion. And that would be a fantastic opportunity to convert some money from IRA to ROS, realize much less taxes, and move forward with growing that ROS account tax-free forever. Retirement account contribution limits. So this is something that most people know, but that's a nice summary page where you can see that if you're under 50 years old, you can contribute $6,500 into traditional and Roth. 401k would be $22,500. Either it's a solo 401k or employer 401k, doesn't matter. By the way, this is the aggregate amount, means if you have two 401ks, you work in two jobs, then you still only can contribute $22,500 between all of your 401k plans. Simple IRA, it's another retirement plan, usually available through the employer directly, and it's for $15,500. Not my favorite plan because contribution limits are very low. SEP IRA plan, maximum contribution is $66,000. However, it's limited to 20% of your net income from the business. So if your net income from the business is only $20,000, you cannot put away more than 20%, so $2,000, right? So as a result, a SEP IRA contribution usually very rarely are maxed. And total defined contribution plan, which is would be the total amount where between your contributions, which is $22,500, your employer contributions, whatever they match you, plus your after-tax amounts, all of that together cannot exceed $66,000. All right, and then we also have a catch-up contributions, which will be for those over 50. There is one caveat that not everybody can put money in a traditional Roth IRA. Unfortunately, AGI limits, adjusted gross limits, matter a lot, and it's phased out pretty quickly. For married filing jointly, if you are especially if you're a participant into the retirement plan, so let's say one spouse doesn't have a retirement plan, another spouse has a 401k. It's the one that's contributing towards 401k makes the other person ineligible for the regular traditional IRA because of the phase-out amount. And that amount is unfortunately very low. It's the phase-out amount is literally for the IRA contributions, you can see it's 116, and for the Roth is 218. So it's very low numbers, especially for those in Silicon Valley. 90% of people who come through my door are not eligible for direct Roth IRA. They're not because of the income limit. AGI kicks them out of eligibility for Roth IRA. So the question then, what do you do? The simple way is to make a contributions into your 401k if you have one, but not into the Roth 401k, into after-tax account within your 401k, and then immediately roll it into the Roth. We can talk about the strategy in a few minutes, but I would like you to think about it. And if your 401k company provides after-tax contribution, please consider it as one of your benefits, because if you put money there and roll it immediately into the Roth 401k, guess what? You just created the Roth account for yourself without income limitations. Choosing between traditional and Roth accounts. Always, every time people trying to make a contribution, they're deciding which is more beneficial. Well, the simple way to look at this is traditional IRAs are tax deductible for those who are eligible for making a contribution. However, because the thresholds are so low, most likely a lot of people will not be eligible, but deductibility is there as long as you can make the contribution. A Roth account is growing tax-free, but the amount you're contributing toward this account is not tax deductible. So a lot of people who are making over $200,000 would probably benefit if they already have a 401k, they're maxing the contribution amount, they probably benefit from the Roth account. Making Roth contribution, if you're eligible on an annual basis, is very beneficial because that account will grow tax-free, number one. Number two, that account is not subject to required minimum distributions, which is critically important. Remember, RMDs will come at a certain age, doesn't matter, 73 or 75. By the way, for those who are born after 1961, your required minimum distribution is 75 years old, which is fantastic because they just pushed it out almost 4.5 years for a lot of people. And however, you still will be subject to RMDs. Roth accounts are not subject to required minimum distribution. You can leave that account alone to grow as long as you like. Very advantageous. A traditional 401k plans also have a Roth provisions. Many of them do, and if they do, you can make a contribution toward your Roth 401k. Let's talk about consideration for Roth conversions. My favorite topic. Roth conversions in general are not beneficial if you're in your full-time working highest paying years, because if you are making a Roth 401k contributions, you are depriving yourself from making it on a pre-tax level. So my recommendation is always max on your pre-tax 401k contributions first, which is for folks who are 50 or older. It's $30,000 this year. It's a good amount of money. If you are in a 25% effective tax rate, you will save enormous amount of money. On $30,000, you can save a lot of money. You can save almost $7,500 in taxation by making contribution toward pre-tax 401k up to the maximum limit. Once you made that contribution, the second option would be for you to make an after-tax contribution. Remember, I told you there is a $66,000 available to contribute between you, your employer, and your after-tax money. So you can make pre-tax amounts, $30,000 if you are over 50. Then your employer will put a match, let's say additional $10,000. So now your account already received a $40,000 contribution. Remember, the max is 66. So you will still have $26,000 that we can make an after-tax contribution and on a regular basis per paycheck, whatever we can afford, and roll it immediately into the Roth. By doing so, all the earnings into the Roth 401k will be tax-free. So now let's talk about conversion. Conversion in between your IRA and Roth usually happens at the time where you either between jobs, you have no income, you quit your job, you're starting your business. This is the time when your income drops significantly, and we know that your income will increase over time. Either you will start taking RMDs from your sizable IRA 401k, or your rental income will kick in, your social security will come in a few years. So there is a grace period between now, when you might not have an income or very low income, and later when you will have social security benefits, IRA distributions from RMDs. So there might be a very beneficial time when, if you convert certain amount of dollars from IRA to Roth and pay only 10-15% tax, you might benefit by paying lower tax now, sheltering your money in a Roth, and growing that tax-free in Roth account. This all of these considerations needs to be very carefully examined, analyzed. I have a special system analytics where I can see the Roth conversion now versus later, what's the tax bracket will be at a certain age, and only then we will decide what amount we will convert. So it needs to be very carefully considered. Don't go full in. Don't decide, oh, I want to convert $200,000. Not a good idea. Distribution, by the way, from any retirement accounts are subject to penalty of 10% if it's done before 59.5. So, but because you're not taking money out, you're making a conversion from IRA to Roth, this age limit does not matter. Let's talk about health savings account. One of my most favorite accounts. I love it. Why? Because that will allow you to save more money on a pre-tax level and pay for some healthcare, co-insurance, drug co-payments, something that's not covered by your healthcare plan, all out of that HSA account on a pre-tax level. Excellent account. The family contribution max is $7,700. If you're over 55, that will be $8,700, almost $9,000. All of that will come out of your paycheck on a pre-tax level. If you're self-employed, you can also set up an HSA. If you have a high deductible plan, that's the only time you're eligible for HSA. No other medical plans will allow you to have the HSA account besides the high deductible plans. So HSA account doesn't need to be depleted. It can stay enrolled into the new year. You can even invest that money and grow it on a pre-tax level. Once you reach age of 65, you can take money out without penalty for any use. It works exactly like an IRA account, but you will have to pay taxes. If you take money out of the HSA account for healthcare expenses, for eligible medical expenses, then any earnings and any principal that were taken out will be tax-free. Excellent account. Everybody who is eligible should be considering it, because it's an account that you will never feel that you just wasted your money, because you put it away and you will keep it for any medical expenses. Either braces will come up or some high-end medical expenses, something, the drug that is not covered by insurance, anything medically related, glasses, prescription drugs, some over-the-counter medicine. So that account is excellent account to have. Most people would qualify as long as they have a high deductible plan. If your plan is not high deductible, then you are not eligible. IRS does not allow you to open this type of account. It's nice to open, but I don't believe it's a right account and appropriate account in that case. Qualified business income. Because we have a lot of slides, what I'll do is I will skip through a few slides. So basically, QBI is a type of deduction that a lot of businesses can get based on their income and type of business. Unfortunately, specialized service businesses like lawyers, financial planners like myself, accountants, accounting professionals, athletes are subject to phase out, and their phase out starts of the taxable income between 360 and 400,000. So if you have this type of income, you will not have any QBI deductions. So just you know. It's a newer deduction. Not everybody aware of it, but a lot of people are using it. All right, let's talk about investment income. This is where I like to spend a lot of my time looking at investment income for clients. So you can see here that what we talked about, long-term capital gain rates are quite favorable these days. You can see if you're married filing jointly and that particular year you quit your job and you took a sabbatical and you sold your stock to live on it, you can pay zero capital gains tax if your taxable income is $89,000 or less. Amazing. Same applies to single person, 44,000. Once your overall taxable income goes above those limits, then you pay flat 15% tax rate. And the highest rate you will ever pay, doesn't matter if you have a capital gain after the sale of your home, $500,000 or $5 million, you will only pay flat rate of 20%. So you're capped at that rate. This is one of the lowest capital gain rates that we've seen in many years. I know they've been here for a few years. We were very concerned at the beginning of this year that these rates will go, but they decided to keep them. So it's a very important slide for us to keep in mind, because if anybody wants to accelerate their capital gain distribution and would like to do it on an incremental basis each year, they might be able to pay only 15% tax on capital gains, which is quite lower than you would see it otherwise if the same amount of income would be subject to ordinary income tax. All right, recognizing capital gain, short-term versus long-term. I don't want you to think about it too much. It's very simple. In 1 year, all your total short-term gains will be offset by short-term losses to come up to net short-term position, means gain or loss. And then you do the same thing on the long-term transactions, long-term gains versus short-term gains. And on the long side, on the long-term capital gain side, and then you will have a net long-term position. Then you will finally switch between long-term and short-term gains and loss, and you will see the net results. In 1 year, you can offset any losses and any gains without consideration whether they're short-term or long-term, and recognize either a gain or a loss. That gain or loss will carry the character of whichever came largest, right? So if we have very small short-term loss, but very large long-term gain, the net number will be long-term gain, and that means that you will be reporting it. And guess what? If it's a long-term gain, you will pay a maximum of 20% tax. That's the one we just saw before. Now we will be moving on to talk about there's a few other considerations and investments. One of them is wash sale. I don't know if anybody ever was subject to wash sale. It's a very disappointing experience. It's interesting enough that a lot of people got caught up by surprise, because if you buy one security, example here, you bought it on September 7th, you have to wait 30 days. So if you sell it 30 days after and immediately buy it back, if you had a loss, this loss will be disallowed. So if was bought securities on September 7th and was sold it as 30 days after, we need to wait another 30 days before we can buy it back. Otherwise, this loss will be disallowed. So the way we manage it here in the office, and we've done a lot of capital losses harvesting, because last year was, even though bad year for the market, extremely good year for taxes. You need to follow certain IRS rules to make sure that you don't fall under wash sale rules. So we're very careful. We have our calculators, we have our rules out. But if you sell one security that's at a loss, last year was very easy to do, you can buy back pretty much the same day or the following day very similar securities, but not identical. Example is, I want to sell an ETF that carries technology stocks, and it's from one ETF provider, let's say from WisdomTree. And then I want to buy back, I still want to hold technology in the portfolio, but I want to realize the loss, so I sold it. Then I'll buy back technology from iShares or BlackRock that carries very similar allocation, maybe not exactly the same stocks, but it moves and makes money in a very similar manner. By doing so, we realize paper loss. Instead, we just did an exchange, right, from one to the other, of $1,000. that $1,000 will be carried forward on your tax return till it is offset by the capital gains. So it's never wasted, it doesn't have expiration date, and you just need to be very careful not to get the wash sale going. But if you can, then this carry forward loss will be very helpful to you when in 2022, in 2023 or 24, you start to make money and you sold your Tesla stock at 4,000 gain, but you have $1,000 loss to offset the gain. And then now your total liability goes down to 3,000. So this is an excellent way for you to avoid taxes, reduce taxes. Loss harvesting is a very active process. It's not the process where you just do it once and forget it. I actively loss harvest through the entire year because every year we have an opportunity for loss harvesting. For instance, market went down just recently in the last few months. You see bonds are down, some stocks are down. It's the opportunity to reshuffle, opportunity to get those paper losses reported on 1099 because they can be used for reduction of your future gains. Excellent strategy, need to be considered. Every single investor need to look about it, think about it, look into that every year, especially when the market is down. Let's talk about equity considerations that provides tax advantages. So basically what it says that if there is a way for you to shift income from ordinary income to capital gain, it's a huge advantage because capital gain taxes are by far lower than ordinary income. Top marginal tax brackets you can see here is 37.9%, including all of those Medicare surtaxes, where capital gain taxes max could be 27%. This is it. So it's very important for us to understand the difference. The capital gain tax are by far lower than ordinary income. So please, if it's a possibility, try not to realize short-term gains because short-term gains will fall under ordinary income category. So I would like you to be very mindful every time you need to buy and sell to look into, is that a short-term gain or it's a long-term gain? If it's a short-term gain, you need to wait 12 months and 1 day before you can sell at the long-term gain rate. Equity compensation, this is a very deep topic. I probably need to just run a separate seminar for it, but qualified disposition, 83B election, net unrealized appreciation. I'm just going to summarize by saying, if you have a company stock in your 401k, then you need to talk to your tax professional and financial advisor before you roll your 401k into an IRA, because you might benefit from something called net unrealized appreciation. Potentially, you might benefit. A lot of times I see there is no benefit of it for a number of reasons, but it needs to be analyzed and considered before you make a rollover, because once you make a rollover out of your 401k, where you have your company stock into the IRA, this net unrealized appreciation treatment is gone. So please do consider that. It's a very important consideration for some people because you might be able to save on taxes. I'm not going to go into details. It's quite complicated, but just pay attention to that. Always talk to your tax person or talk to somebody around you, talk to your financial advisor, making sure that you're looking into those considerations for taxes. Let's look at this chart. I actually really like it. People say, well, I'm making 5% right now on money market accounts, and they're very happy and proud, and I'm happy and proud for them as well. But you need to remember, if your marginal tax rate is 22%, for many of us, then you're only pocketing 3.9% into your pocket because you have to pay tax on ordinary income tax for any interest earned on a taxable bonds. Opposite to that, if your municipal bond, California, tax exempt municipal bond is making 4.4%. It is lower than your money market account at 5%, but you are in the 22% tax bracket. Is that more advantageous that have a 4.4 municipal bond that federal and state tax-free than have a money market that pays 5? The answer is yes, right? So we always need to see what our tax brackets, are we subject to a higher tax rate if we earn more money that's a taxable, or alternatively, if I'm in a higher tax bracket, 22% or higher, I might benefit, besides my money market, to be also municipal bonds. By the way, it's absolutely separate topic, but I cannot not mention it. Currently, municipal bond market at so low, the prices are so suppressed and depressed. We have not seen these prices in municipal bond markets in the last 20 years. I believe this is one of the biggest opportunity for investors who needs municipal bonds. Number one. Number two, once interest rates stop rising and Federal Reserve will stop increasing rates, municipal bond prices will stabilize, and then they will be going up probably very quickly from that point on. So there will be a lot of opportunities to make a very good income and very good appreciation on bonds. I will see this type of bond sell-off ever in my life again. So this is amazing opportunity. I'm just sharing it with you. Maybe it's not time to jump on it yet, but the time to watch it very closely, because you probably will be able to make stock market like return in bonds in the next couple of years. Yet to be seen, but the backdrop for it does exist, and it's very strong. A review asset location for tax efficiency. Well, this is an absolutely amazing slide. I love it because you can see that the taxable account should hold passive investments, right? Because they are low capital gain investments. There is no active management going inside. Qualified dividends that are taxed at the lower rate. Long-term holdings that you're not planning to touch. Tax-exempt bonds. We talked about municipal bonds and for Californians, right? California state-exempt bonds. Investments subject to foreign taxes. Well, obviously, because if it's a foreign tax, that will be taxed probably on origin level. Now, tax advantage accounts on the other side, it would be the accounts that would be your IRA, 401k, SEP IRA. So these accounts can hold actively managed investments. It doesn't matter, whatever sold and bought inside, not subject to taxation. Not like your taxable account. Every time you buy and sell, you realize the gain. Even if you exchange one fund within the same fund family, it's considered the same. Short-term holdings, not qualified dividend positions. For instance, there is a fund that pays non-qualified dividends, taxed at an ordinary rate, otherwise in your non-retirement account. But in retirement account, it doesn't matter. So tax efficiency instead of your retirement account, it absolutely doesn't matter. So you need to be aware. Where do you want to keep your different investments? Municipal bonds obviously going into taxable accounts, non-qualified dividends going to tax advantage account, high yield bonds going into your 401k investments. This way you're optimizing what you're reporting to IRS every single year on your 1099. Let's talk about itemized deductions. Everybody loves it. We know that our standard deductions went up quite a bit, which is great news for most people, not for Californians. I mean, it does help us somewhat, but what really doesn't help us is this limit. I actually highlighted it: SALT, state, and local tax, which is our property taxes, right? Capped at $10,000. So if you're working individual and you are making $200,000+ and you're a single person, your state taxes probably at least $8,000 to $10,000. And you own a home and you own $1 million condominium, right? Then there's another $11,000 worth of property tax. So previously, before the Trump passed this law, we were able to deduct the entire 10 property tax plus 10 state tax on your tax return and get the write-offs. Now it's capped at $10,000. It's a complete joke. It's basically a complete huge tax increase for everybody who has a higher property taxes, which is Californians, New Yorkers, and also people who make more money, which is also Californians and New Yorkers. So we right now in a very bad situation because our deductions got decreased dramatically. So we hope that this law will go into sunset in 2026 and the SALT deduction will go away, but yet to be seen. Nobody touched it so far. It's been around for at least 3-4 years. Single standard deductions did go up. Great for married filing jointly. You can almost deduct $30,000. This is the great news. But unfortunately, it's really doesn't benefit us because of the SALT. The SALT is really the tax that's very difficult to I mean, you can't deduct anything that you pay. No property tax, not state tax anymore. Mortgage interest is all deductible up to $750,000 mortgage balance. Charitable gifting has some limitations. We'll go over those, but they're deductible. And medical expenses. This is all your itemized item. If your itemized deductions are below your standard deduction, then you claim a standard deduction first. If your itemized obviously is higher, then you're jumping on it. Now, some tax considerations. Let's say in 1 year, your standard deduction is $27,700, like 23, and your itemized deductions are $28,000. Very little difference. And the reason you itemized at $28,000 because you made a $2,000 contribution toward charitable gifting, plus you had the mortgage interest, medical expenses, you were able to get to $28,000. So then my advice would be to claim a standard deduction. Don't worry about your charitable contribution because every year you make a $2,000 contribution toward charity. But next year, if you have a very similar itemized deduction, double up on your charitable contribution. Instead of making $2,000 this year, you're going to make $4,000 next year for this year or next year. And guess what happens? Now your itemized deductions go from $28,000 to $30,000. So now you can deduct a little bit more than otherwise you would do year by year by year. So shifting around your charitable gifting, medical expenses if possible, and aggregating them in one particular year can reduce your overall taxable income significantly. All right, so I went through a lot of slides. I will just quickly get through a few more. I know we're at 7:45, so I'll start taking some questions because I want to make sure that I'll give you some more information on top of what I talked about. Topic of taxation is extremely, extremely big. And for us, we probably need 2 days, 2 hours each just to get through these slides. But I want to give you information just so you have food for thoughts. And you go where to, you know what to ask next time you're meeting your professionals. So you can see here the top marginal brackets, California is probably the highest. So that's why municipal bonds that has no federal and state tax are extremely attractive, okay? When we're talking about relocating, if people are relocating, there's proper steps you need to do for tax purposes. So I'm not going to go too much into this, but I do want to touch on charitable gifting because a lot of people doing this contribution, they just need to know how to do it right. So you can make a direct gift, cash, personal property, life insurance, real estate, and have a particular write-off. You can also open something called donor advised fund. Very popular funds. They're available everywhere. And donor advised funds, you can make a large contribution toward the fund, let's say 50,000 or 100,000, and then every year decide how much you want to. So you get the deduction right away. And so are you aggregating your deductions? Maybe you sold a lot of stocks and now you need a significant deduction. So you're making donor advised fund contribution. Once you made the contribution, that amount is fully deductible in that particular year. And then each year you will be writing a check to different type of charities of your choice directly from that account. That's already been deducted. And 1 year you can write a lot of checks, other year you don't have to write, but it will be constantly available to you. Split interest vehicle is actually a very interesting mechanism through charitable remainder trust, charitable lead trust, pooled income funds. I'm not going to touch on it a lot. It's very complicated, but one thing I will say that I've studied those, and I know that if you want to donate certain money to charities in exchange for the income stream to you, that will be taxed on as ordinary income, you just received a large deduction And then over time, you'll be reporting income that coming from that fund as the supplemental income to you and will be taxed. So that will give you large deduction one time and also income stream for life. Interesting, a combination of things. I'm happy to discuss individually because it's very, very complex. And private foundation for people who are making large contributions toward charities, they can set up a private foundation. Deductible limits for charitable gifts. You can see that there are some AGI limits for ordinary income, property, long-term capital gains. So this needs to be followed. Usually it's your tax person who will give you guidance. I'm happy to give you as well, but you can see these are the public charities, private charities, they have different limits. All right. Bunching itemized deductions. So we talked about that, and example was that if when you want to make a charitable contribution in a lump sum, it's actually serving you better than doing a small chunks. And the reason for that is because when you're doing the small chunks, then you might not even exceed your standard deduction. So making it a bulk or doing it every other year is actually much more beneficial. Donor advice fund, we talked about that. This one I really want to touch on real quickly. So after age of 70 and a half, you can make a charitable contribution directly from your IRA, and you don't have to pay tax on those distributions. You can also use part of your RMD's required minimum distribution to send it to charity, and that amount will be excluded from your taxable income. You need to keep a very good record because your tax person will need to know who you send the money in order to deduct it. So you need to keep a very good record. You need to have either a copy of the check or where the transaction went, so your tax person or you yourself can report it and you don't forget it. But it gets 100% deduction and you don't have to pay taxes on those distributions from your IRA. You have to be at least 70 and a half. SIP IRAs, simple IRAs are not eligible, unfortunately, just regular IRAs. Okay, legislative updates, Secure Act 2.0. I did teach Secure 0.0 at the very beginning of the year. I ran few presentation on it, so I just want to tell you biggest considerations here. It's a big act. I will tell you most applicable changes. So RMDs we talked about, right? Delay till 73 and 75 and 2033 for people who were born 1961 and after. Your RMDs age 75 and up. You're reducing penalty for those who didn't take them on time. Remember, 50% heavy penalty to 10 to 25%. They understand people are getting older, people forget. It's really not nice to treat them with 50% penalty. People will be auto-enrolled in 401ks. This is great. A Roth 401k will be eligible. Catch-up contributions are there. One thing that really I didn't like about this new act is that people who make over $145,000, which is pretty much everybody in Bay Area, will not be able to make any catch-up contribution into 401k on a pre-tax level. That's starting 2024 next year. I hope they're going to remove this provision, but if not, remember I told you that you can make $30,000 pre-tax contribution into your 401k. Guess what? If your income is over 145, you cannot make catch-up contribution. 7,500 will be only available on the Roth level. 22,500 on a pre-tax. The remaining, you only have to put it into Roth 401k, which means your tax bracket goes up a little bit. So didn't like that, but what can we do? A lot of easing went on the side how you can access your retirement plans. Emergency savings account was became available. It's very, very small. It's like a couple $1,000s, I believe, available through emergency savings. A retirement plan access that part-time employees can access. There is a lot of ways for you now to access your 401k was based on certain conditions, and those conditions apply to you. You can access it with little penalty or no penalty, and etc., etc. So there is more ways to access your 401k now than was before. But nevertheless, I would suggest that you try not to tap into your 401k if possible. I think for many people, that's the case. So for right now, I'm going to stop, pause, and I will be happy to take any questions, and maybe Lisa can help me facilitate it.
Yes, thank you, Larissa. There are a few questions in the chat box, and those of you who have questions, please enter them in the chat box, or you can unmute yourself and I'll call on you. So one of the first questions from Elizabeth was, if your employer offers traditional 401k only, can you open a Roth IRA outside, like with a Schwab or Fidelity on your own?
Yes, absolutely, you can. There is no law saying that you cannot do it. You can open a Roth IRA. You just need to be aware of those AGI limits. You need to see if you're eligible to put money directly into Roth or not. And if you are, you absolutely can put away money without any limitations. It's only AGI limitations that will preclude you from making contributions. But can you open an account? Yes, of course you can. Good question.
Okay. And Edith asks, how is it possible to know if it's better to keep a tax-deferred annuity account with a fixed interest rate of, say, 2.5%, or to withdraw the funds and get a CD with double that interest rate?
I have these questions lately a lot. So the way we'll calculate it is very simple. You take an Excel sheet or you write it on a piece of paper. You will write down how much your CD is making every month till maturity at the current rate, 2.5%, right? And you know by what date you will mature. Let's say it will mature by June 2024. So by June 2024, you're going to make a cumulative interest $1,000. And then you say, what if you break that CD because the rate is so low, and now you're starting a new CD, and how much you're going to make in this new, you pay the penalty, you need to consider that, and how much your new CD will be making, let's say 5%, and how much you're going to make in that CD from the point you broke it till the same date, which is June, let's say 2024. And if that amount is larger, the answer is clear. Breaking CD, paying penalty is more advantageous to sitting in the one that's 2.5%.
Okay, and
right? Makes sense?
okay, and would that apply also to a tax-deferred annuity account?
Tax-deferred annuity account would work very similarly. The only difference is you need to make sure there is no surrender penalty. Sometimes it's a very heavy surrender penalty. So for instance, if you break the tax-deferred annuity, and you would have to pay you will have to take all the money, and if there is any interest earned and was reinvested, you would need to pay taxes on that accumulated interest, right? So that's one consideration. The second, you need to ask the company if there is any surrender charges. A lot of times, any annuities carry very heavy surrender charge in the first couple of years of its existence, and then it becomes less and less and less, and it goes away. So two considerations: taxes on any earnings that you will be taking out, and second is surrender.
Okay, thank you. Let's see, there's a question. If you are on your spouse's healthcare plan, can you do an HSA on your employer?
Yes, it will need to be a high deductible. So first of all, in order to qualify HSA, I know what you're asking. I've actually studied this question very deeply myself. So the only thing I'm not clear is, do your spouse healthcare? So if you are on your spouse's plan, he can open an HSA account with his employer, not yours, if you're on his plan. And he will make a family contribution of $7,750. You will not be eligible with HSA plan with your employer unless you are a part of your employer high deductible plan, and then you're eligible for HSA. So okay. It has to be a high deductible plan, and you need to be in that plan. If your husband already has an HSA, you're part of that plan, he can just make a family contribution. You cannot do it another one. You won't be eligible unless you have a high deductible plan also through your own employer.
Okay. And then there was a question, I think, when you were talking about I think long-term maybe gains or something.
Okay,
Somebody was asking about whether you were talking about California taxes or federal taxes.
it's federal tax. Everything we
Okay.
discussed today is all federal tax.
Okay.
No state tax consideration. I only showed one slide about how high the California state taxes are, but no, everything was federal.
Okay. And then somebody says that the catch up to the Roth 401k has been postponed to 2026.
Oh, wonderful. That's right. That's great. So I'm happy. I'm happy that they pushed it out.
Okay.
This is great.
And somebody wants to know if you can discuss 529 to Roth conversion.
Great question. That's also a new provision in Secure Act 2.0. So 529 you'll be allowed to move certain dollar amounts. I believe it's up to $15,000 over the lifetime of your 529 into the Roth. And by doing so, you pay no taxes. So there is, but keep in mind, you cannot move 15,000 all at once. It's subject to your Roth contribution limit, right? So if you're under 50 years old, you will have what I forgot, $5,500 eligibility only to move from 529 to Roth. So let's say the child graduated, we don't need money in 529 anymore, we don't want to keep it. He or she is not going to graduate school. And we have $15,000 left in that account. And that account needs to be opened, I believe, for at least 15 years. It cannot be a brand new account. It has to be there for a while. Then you're allowed to move up to the maximum Roth account contribution limit annually from your 529 into the Roth account for beneficiary. That 529 beneficiary and the Roth account owner has to be the same person. And you can do it 3 times. Up to $15,000 max, something like that. Maybe it's 15,500, but it's that number. So there is a lot of limitations, even though it sounds really good, but there is only 15,000 limitation. You have account has to be open for 15 years, and then you're only moving one chunk at a time. So, but that's the overall provision saying, yes, you can do it, but there are some lifetime limits on that amount, how much you can move.
Okay. A person asked, how with high CD rates now, would it be a good idea to buy 5 and 10-year CDs in a fixed income portfolio? How high have rates been in the past?
5 to 10 year CDs?
Yeah.
I have not seen those because the banks are smart. They know they don't want to give you 5-year CDs or 10-year CDs because I don't know the rates on those. Maybe they do exist. I only see 12 months, 18 months, 24 months. That's attractive rates. Like you can see 4% rate, 4.5% rate, because bank knows 2 years down the road, the interest rates will drop somewhat. We don't know how much, but they will drop. They don't want to lock on money for you long term at the higher rate when they know if they renew the rates and rates drop, they don't have to pay as high interest. So if you're able to secure a 5 to 10 year CDs at the rate of 5%, this is fantastic because it's a low cost and it's also guaranteed rate, right? But you know,
okay. This person says that there are 5 and 10-year CDs, I guess, at Fidelity at like 5.65. She's direct messaging me, so you probably don't see that in the chat.
Okay. If
they're brokered, I guess.
you need to look in and she also asked about what historical rates been. Historical rates on CD at 5 or 6%, it's very good rate. I don't believe this rate will stay for next 10 years. So if somebody offering you at no risk, right? Because CDs are risk-free FDIC insurance, if that's product exactly what it is, means that the FDIC insurance certificates of deposit that's guarantees your principal, and you lock it for 5 years because you really don't need this money at 5.5 or 5.6%. It's a pretty good rate. Historically, we've seen these rates probably in its 80s. I mean, I did never seen these rates. I mean, the only disadvantage is you have to pay income tax on it when you take the CDs out, right? Because all the interest will be taxable, but the rate is great. And if it's FDIC insurance, then you have no problem. You just need to see if it's brokered CDs. Some CDs are presented like CDs, but they're not real CDs. They're brokered CDs. And brokered CDs have completely different rules. So you have to be careful to see what kind of CD it is.
Okay. Let's see. Could you please elaborate a bit more on municipal bonds? How do we watch the best timing to buy?
Oh, it's $1 million question. By the way, this question has been asked. The largest US financial institutions are currently asking this question. So it's never going to be a very distinct timeline, because usually it's easy to see when it's already passed, but I'll give you some pointers to consider. Number one pointer is interest rates. Bond prices bottom when interest rates top. So which means when Federal Reserve will eventually stop raising rates, and we know for sure they stop raising rates are not going up. That will be a time when the bonds will bottom, bond prices will bottom. Once the bonds prices bottom, there will be a process of it starts to go up, and anticipation from what I read from Capital Group American Funds, that from the time when an interest rate stopped till the time when the first interest rate cut happened, usually takes about 8 to 12 months. Within that period of time, the most return on bonds will be made historically. So now you need to watch it. You need to watch interest rates. You need to watch bond prices. You need to watch bond yields. There is the bond managers that's all they do all day long is they watch it. If it's difficult for you to do on individual level, for individual bonds, you can do it for bond funds, which is easier, but you monitor the price. You see what the Fed is doing, and then you try to time it. Very difficult to do. Any timing is always difficult, but you can attempt. I think we're very close to that moment. Whether it's going to be this year or beginning of next year, but I think we're very close to that.
Okay, and somebody asked, are Treasury bond, U.S. Treasuries not better than municipal bonds?
It depends. Treasury bonds are secure instruments of U.S. government, but I believe they are federal tax and state exempt. That I believe that's the tax. I always forget if it's a state exempt or federal tax or other way. I believe it's a federal tax state exempt. Where municipal bonds, if you're buying California municipal bond fund or California individual bond, and you're a resident of California, you have federal tax-free and a state tax-free. Then you need to calculate taxable equivalent yield, meaning if I were to get a CD, how much rate would it be in order for me to break even in municipal bond securities, right? So if your municipal bond pays 4% and your taxable equivalent yield is 6%, then your equivalent yield to earning that interest in CD is 6%. So for people who are in a high tax bracket, municipal bonds generally is a better one to avoid taxation, but not for everybody. So treasuries are good, but treasuries don't have tax exempt interest all alone, or municipal bonds do.
Okay.
California municipal.
Okay. There are quite a few other questions, and it's already almost 8:10. So I'm going to, is it okay if we do 2 more questions from people that I haven't asked from yet? So Allison asks if 2 working people can have 2 HSAs and basically put away $15,400 total together.
Can the 2 people do that? Can people have 2 HSA accounts? One spouse is one with high deductible medical and the other one has one with a... Well, my understanding that 7,750, it's for the family. So the way I read it, I've never seen people have 2 HSA accounts for 70, because yes, you can, but your limit is not going to be 7,700 because 77 is for family. So yours is going to be 3,600 and he's going to be 3,600. So total is still 7,700. So I don't think it's double it. I think it's a family limit, but you can have 2 HSA accounts, correct? But the limit's going to be, I think, my understanding and confirmed with the tax people that this is the full limit for the whole family. So double check that, please. Mhm.
All right. And then I guess people can check with HR at their companies.
Right, exactly. They can check and say, hey, if I have HSA and someone else, and if you really need the answer, I can find out. I can look into that after the presentation.
Okay. And then Will wants confirmation that you mentioned converting to a Roth IRA may not be ideal for a full-time W-2 earner over the age of 60 or 62. Is that correct?
Correct. So when you're a full-time earner, so you're already making good income, I assume, right? Or maybe you are just started the job. Like I just have some people that are starting a job, they haven't worked the whole year, they're starting a job. Then Roth conversion might work well for them because next year they're going to make so much more money. But if you have worked full year and you know that the following years you're going to be making as much money, then why do you want to convert from IRA to Roth, pay even more taxes, where you need to calculate, is the conversion rate today when you're working is going to be lower than the conversion rate or your IRA distributions later in your life working, in your life? And the answer is no. If your current rate is going to be higher than the future rate, then why would you convert? If the answer is yes, it is lower than the future IRA distribution, so future conversion opportunities, then you can convert. You need to always compare conversion rate today versus conversion rate down the road, and then make a decision.
Okay.
You generally, it's not advantageous.
Okay. Thank you, Larissa.